Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic income. In this question, you will learn to prepare a ledger account correctly and also understand how the relevant journal entries connect within the ledger account. We will discuss two accounting theories which requires us to adjust for the income at the end of the financial year. So this question is specific to POA 7087 and POA 7086 students. So what I need you guys to do now is follow through for an excellent understanding. So let's begin. PQR Enterprise provided the following information. So at 1 April 2021, we are given the interest income receivable of $2,000. Now, at the beginning of the year, we have been provided with a current asset. Why is this a current asset? This interest income receivable refers to income that we have earned in the previous financial year ending 31 March 2021. But in the previous financial year, we didn't receive this income in cash. In this new financial year, starting 1 April 2021, we expect to receive this cash, okay? Then at the end of the financial year at 31 March 2022, we are given the interest income received in advance of $1,500. So this interest income received in advance refers to a current liability which we have got at the end of the year because we have received the cash, but we have not yet earned the right to say that this is actual interest income. This income is something we will earn in the next financial year starting 1 April 2023. But at this moment, which is at 31 March 2022, this is an obligation for us to fulfill our requirements in the next financial year, okay? Then we are given the interest income per month to be $2,000. This means if I want to calculate the total interest income starting 1 April 2021 and ending 31 March 2022, I simply multiply $2,000 on a monthly basis with 12 months which we have got in a financial year. That gives us $24,000 altogether. So what do we do with this total interest income when it comes to the financial statements? So in the financial statements, as part of your other income, what you will show in the statement of financial performance, which is the income statement, okay? All right, so the requirement in Part A is to prepare the journal entries to account for interest income for the year ended 31 March 2022, including the closing entry. So all journal entries that we have got for the entire year, starting 1 April 2021 and ending 31 March 2022, are what we have to record. But as an extra, what we will also learn is how to correctly prepare the interest income ledger account. So let's look into that. So here we have the interest income ledger account, which is prepared using the usual 5-column format with date being in the first column, followed by the cross-reference of accounts in the particulars column. Then we have got separate columns for debits and credits. And lastly, we have got a column to show the final balance. So to start the year at 1 April 2021, we are given the interest income receivable, which we have already established to be a current asset. So let's recall, why is this a current asset? Because we have earned this income in the previous financial year, but we expect to receive the cash this year. So there are some economic benefits attached to it, which falls within the definition of a current asset, okay? All assets by default must have an opening balance on the debit side, which means when they increase, we debit them. So that is why we are recording $2,000 in the debit column for interest income receivable at 1 April 2021. And this gives us a final balance of $2,000 debit, okay? Then for the year ended 31 March 2022, we have got interest income received in advance, which we understand is a current liability at the end of the year because we received the money, but we have not fulfilled our obligation. Our obligation is only going to be fulfilled in the next financial year. And when it is fulfilled in the next financial year, only then we can say that this is income which we have earned. But at the moment, this is not earned income, just that our customer or the investment that we have made just paid us in advance, okay? So since this is a liability, Let's look into this table first. So we understand assets by default must have an opening balance on the debit side, which means the closing balance must be on the credit side to make sure the fundamental rules of the accounting balance, okay? And then you have got liabilities, which by default is always credited, which means an opening balance is always credited, which also means when it increases, we credit it. Therefore, the closing balance must be on the debit side, okay? So at the end of the year, we have got a liability, which we have established. Therefore, we will record the closing balance in the debit column. So that is what we're doing essentially here for interest income received in advance of $1,500, okay? So we have got two debits so far. So 2,000 added to 1,500. So that gives us 3,500 debit altogether, all right? Now, what about the total interest income which we have earned for the financial year starting 1 April 2021 and ending 31 March 2022, given that we understand that interest income is $2,000 per month, therefore for the entire 12 months it is $24,000. So what we are doing that is going to prepare a closing entry in this case. So let's look into the journal entry first for this closing entry and have some discussions. So here we have the closing entry. So when we think of interest income that we have earned, the amount is $24,000 for the entire year. And what we have to do is make sure that all income and expense accounts are always reset to zero balances at the end of the financial year, so that we can start the next financial year with a zero opening balance, and that also lets us accurately calculate profit, okay? Now, what we have to do as part of this closing process is to transfer all the amount for income, which is $24,000 that we have earned, into an income summary account. So income account by default is always credited, which means when it increases, we credit it. Now that we have to reduce this income account, we have to debit it, okay? So reflect that reduction. So we debit interest income by $24,000, and all that amount is transferred to the income summary account, which is credited by $24,000. Now, as part of this closing entry, we understand that we are debiting the interest income account. Therefore, in the ledger account, what we are doing is we are debiting the $24,000 for income summary at 31 March, okay? And this refers to interest income, which we have earned. So altogether, we have got three debits. So $24,000 added to $3,500 debit gives us $27,500 debit, okay? And as we have already discussed a while ago, we want to end the financial year with a net balance of zero for all income and expense accounts whenever we prepare the ledger account, so that we avoid incorrect calculations of profits, okay? So we want to end with a net balance of zero. This is a must. And to achieve that, we can only have $27,500 recorded in the credit column, which can entirely offset the $27,500 debit and thus ultimately result in a net balance of zero. Now, how can we achieve this? Now, we already understand that at the end of the year, we have received cash, and we have actually received excess cash in advance, which is $1,500. That means we have definitely received the cash, which refers to the total income that we have actually earned for the entire year. Right? 100% we have received that. Therefore, it's logical for us to assume that the other journal entry would be relevant to the bank or the cash at bank account entry to record all the income that we have received in our bank account in the form of cash. So what we do at 31 March 2022 is to increase the balance of our bank account to reflect that income which got deposited. So we debit the cash at bank account by $27,500. Cash at bank account in itself is an asset account, and when assets go up, we always debit it, right? So simultaneously, we'll have to credit the interest income account, because obviously we understand this refers to all the interest income that we have earned during the financial year and also not earned, and everything that we have received in our bank account, all right? They would be stored in the income account by default, because whenever we receive anything for income, it is always credited. So we credit interest income account by $27,500. So what this means is that in the interest income ledger account, we'll show the $27,500 in the credit column, with the relevant cross-reference in the particulars column being the cash at bank account at 31 March 2022, ultimately which ends up with a net balance of zero for this income account, all right? Now, So we have already discussed two pairs of journal entries. There is another one at the end of the year at 31 March 2022, which refers to the interest income received in advance. We understand it is a current liability at the end of the year, and all liabilities by default are always credited, right? So when we debit the interest income and we credit the interest income received in advance, we're essentially recording a liability. And you can see when we debit the interest income in the interest income ledger account, we are actually recording $1,500 on the debit side for the income that we received in advance at 31 March 2022, which also meets the criteria of us recording the closing balance of liabilities in the debit column. Okay? All right. Now, let's go to part B. Explain with a relevant accounting theory why PQR enterprise need to adjust for the income at the end of the financial year. All right, so we have two accounting theories here, the accrual theory and the matching theory. Now, the accrual theory simply states that we record income as we earn it, not necessarily when cash is received. So we could use the example we have in our case, which is that we have received excess cash of $1,500, which is not necessarily income that we have earned. Therefore, in our income statement or the statement of financial performance, when we report our interest income, we will exclude the amount which we have not earned, which refers to the current liability that we have at the end of the period at 31 March 2022. Okay? Then another theory you could discuss is the matching theory, which states that profit is simply calculated as the difference between income that we have earned and expense that we have incurred. So the key words here are earned and incurred. So income earned simply refers to income that we can actually match against the expenses that we incurred along the way. All right. So it's not that you haven't fulfilled your obligation. You must fulfill your obligation. So that's when you can truly count something as an income that you have earned because you now have the right, okay? So you could discuss any of these two accounting theories and use the example that we've got in this question to include a statement or two, and that should get you full marks. Now, I just wanted to have a quick chat about another thing in part A. So we are preparing the journal entries for the entire year ended 31 March 2022, and we have looked into 3 pairs so far. So there could be one more set which refers to the original entry at 1 April 2021, which we already have in the ledger account, but not as a journal entry, where we recorded the opening balance in the debit column. So you can see the interest income account is debited and the interest income receivable account would therefore need to be credited. So let's just quickly write that here. So there is another pair of journal entry where we debit the interest income account to transfer the opening balance of the current asset for interest income receivable, which is $2,000. And when we do that, we have to credit the interest income receivable to reflect that transfer in the ledger account that we have prepared above. Okay? All right. So you have 4 sets of entries here altogether. All right, so that's all for today's lesson. If you found value in this content, make sure to drop a like and subscribe to this channel, and check the description for the programs which we are running starting January 2026, Jan 10. And I'll see you in the next one.